We're going to talk about two things I see that are mistakes during tax planning. So the first one is defaulting to buying equipment and therefore taking accelerated depreciation as a strategy. So what I often tell my clients is that buying equipment and the tax benefits related to it are really just a sweetener to the deal. What I mean is you want to do everything in your business that makes business or economic sense. And so we don't do things strictly for a tax motivation. Let me give you an example. Let's just say you need a piece of equipment. That piece of equipment, we'll use a round number, is $100,000. And buying that equipment, you could take accelerated depreciation on it and get a $100,000 write-off in the current year. But that only saves you, let's just say you're in the highest tax bracket, 37%, and your state, like here in Louisiana, is 3%. So say 40%. That $100,000 only saves you $40,000, meaning that's only the tax savings. You still have to pay $100,000 for it. So you're really out $60,000. What I would say is, if you need equipment and you're looking for ways to maximize it, surely depreciation is there and it helps you, but only do that if you need the equipment. Like it's something that it's a sweetener to the deal, or it kind of puts you over the line in the sense like, I was on the fence about buying something, now I'm going to buy it because I get a great tax benefit. But only do this if it makes great business sense, okay? So equipment, you hear lots of people talking about buying vehicles before year-end. I've heard people say, my CPA said I need to go spend money. Again, think about that. If you're spending to get 40 cents back, right, you really lost 60 cents. So just be aware of how you're looking at spending money before year end. It has to be something that makes economic sense. Second thing, the wrong entity structure when you're doing tax planning. And by that, I mean defaulting always to an S Corp election. I've got clients who've made S Corp elections. We've done S Corp elections for clients during tax planning, but we don't default to it. And what I mean by that is, it's lazy to not run the analysis on, if you're a sole proprietor, what it looks like to stay a sole proprietorship, get a higher QBI, less administrative costs, not have to run yourself on payroll, right? There's lots of costs that come with an S Corp, not to mention the rigidity of an S Corp. The S Corps are a lot more inflexible than other entities like a sole proprietorship or a partnership. So if you're doing tax planning, don't always default to making your sole proprietorship an S Corp. You need to know run the numbers, make sure it makes sense, and then elect S Corp if it does.